last article of the day is U.S. home investor share reached all-time high in... No, I'm sorry. That's not correct. That's not what it says. It says U.S. home investor share reached new high in quarter 4 of 2023. Now, hold on. You're like, hey, it's the middle of April. Why are we talking about data from quarter 4? This is from CoreLogic. They literally released this April 9th. So CoreLogic is very thorough and very efficient. And after having collected all this data, they provided a very thorough report with lots of graphs and explanation. And that is why in April of 2024, it's coming out with the conclusions of quarter 4 of 2023. So what they found is the investor share of purchases climbed to almost 29% in December of 2023 and could exceed 30% in 2024. The share of U.S. home investors hit a new high in December. In October, November, and December, the share of single-family home purchases that were made by investors was 28%, 27.3%, and 28.7% respectively, which eclipsed the previous all-time high of 28.3% in February 2023 and makes the investor share rising above 30% in 2024 a distinct possibility.
BlackRock's buying everything. Thank you, ladies and gentlemen.
Okay, so I wrote a note here, and I said, buyers waiting for another correction, investors are not. So buyers, beware. We've talked about this a number of times. We take a lot of crap in the comments about this. I know not everybody can buy. We obviously have an affordability problem. Last week, someone was talking about we're playing in some sandbox that they're not playing in. I'm like, look, we pay all the same prices you do at the store. We carry our own expenses as a business. We have to earn our own income just like you do, whether it's paid for by your boss and your business or we have to go and earn it ourselves. Look,
right.
So anyways, the point is, if you're a buyer waiting on the sidelines for prices to correct, investors are not doing that. Investors are clearly showing that they are willing to buy and hold. And there's even a part of this that we're going to jump to in a second where investors are selling to each other.
Yeah.
So it's an investor-to-investor purchase. So, oh, yeah.
I'll take this deal.
Yeah, the number of real estate, number of closings transactions is increasing year over year. There's a percentage of that that's investor-to-investor sales. So that's also happening. Be wary of that. So the connection between price appreciation and investor activity has been inconsistent over the past few years, but elevated interest rates have stymied appreciation, but not the number of investors. There seem to be more investors coming to the market. So investors now have mostly returned to their pre-pandemic levels of activity. And that shows a stark contrast to owner-occupied buyers who are purchasing about 100,000 fewer homes per month than they were in 2022, before 2022.
One thing I've learned with working with investors, but also working with residential buyers, is that investors aren't looking at purchasing an investment with an emotional lens. They're looking at it for what it is. If the numbers make sense and I'm able to make the margin that I'm looking for, or even in the ballpark that I am okay and I could take this investment, they're going to buy all day regardless of the market, the rate, or what anyone else is saying, because they already know they're playing what they're looking for. And in the realm of what's happening, they're able to attain that. Unfortunately, if you're a residential buyer, you're really looking at this through an emotional lens that you're investing your hard-earned money every month in, month out that you earn, and $100, $200 could make a difference. Whereas investors look at it like, I can eat $200 right now because I know down the line I'll be able to profit, so I'm okay with that right now. That's two different routes where for regular buyers they run out of pocket, or they run out of ability to be able to withhold those higher rates, higher payments for a long time. So they double think it if they're going to get in the market.
Yeah, look, man, this comes down to buyer versus investor. You're not just in the market to compete against another buyer. Now, we talked about this in the last show. I was basically closing out the show saying, look, if you're a buyer and you like a home in San Diego right now, you're not the only one that loves that home. That now also includes, if you're a buyer and you're buying it for your own purposes, you're also potentially competing against an investor that wants it for their portfolio.
Yeah.
So
100%.
That is someone you could be in the arena with. We've talked about this in previous shows too, where the amount of cash purchases is actually increased because rates are less favorable. And also there's other things to compete with when it comes to sellers choosing the best offer. You can cash and close in a lot faster time versus someone who has to get a loan, get an appraisal, get an inspection. These cash buyers are making all sorts of waiving all sorts of concessions of inspection, even like even certain repairs, because again, if they can get the house out of your hands, in a lot of cases, or I shouldn't say a lot, but in some cases, it's the buyer versus the investor in the arena. Yep. All right, so I'm going to read this one out because I want to make sure I say it correctly. In 2021, the line that slopes upward, and I'll put this on the screen, the line that slopes upward showing that counties were higher appreciation that year had a larger investor presence. In 2022, the line is flatter, showing that a higher investor share still predicted strong appreciation, but not the same extent as 2021. And then for 2023, the line slopes down, showing that this trend reversed and higher investor presences predicted lower appreciation last year. Here's my point. It's still appreciation. So again, this is about speed of appreciation, not change of direction. And I want to make sure I'm making this very clear. Investors buying at the current market rate will keep prices where they're at or push them higher. It does not make them lower. If a investor gets a discount on a deal, that doesn't necessarily mean that discount is going to be copy and pasted and applied to every other home in that neighborhood and every other home in that zip code.
Just got a good deal.
It's not it's not a Groupon. Just because an investor gets 10% off on a deal or 20% off because they're buying a dilapidated house, that doesn't mean that all property values sink. Property values are a cumulative response to what has recently been sold, but there are also appraisal conditions, or not conditions, appraisal variables, I'll put it that way, that weigh in on whether or not that house that was discounted can even be comparable to yours.
Yeah.
That is maybe up to code, one, updated, number two, has a pool versus doesn't and needs to be torn down and started from scratch. So there's other things in the numbers that suggest that a discount that they may have got doesn't necessarily mean prices go down. And I want to be very careful here. I want to make sure it's very clear. Speed of appreciation is what we're talking about. We're not talking about change of direction, appreciation versus depreciation.
No, but I feel like when investors take over a property, that speed that you're talking about gets put into motion because of the fact that they come in, they do things to the property that makes it appreciate real fast, rather than somebody that's just paying their house over time and it's going up slowly. They instantly give it, equity or build up that value in it.
Well, yeah. So in that case, let's say an investor comes in and gets a house with a massive haircut. Let's say 20% off. So let's say it's a $1 million neighborhood and you get it for $800,000.
Nice.
Well, but then you dump $150,000 into it to bring it like to code or to bring it up to snuff, if you will.
Yeah.
And then the what you do by adding that $150,000, let's say it keeps it at $1 million.
Yeah.
In value, or takes it to $1,050,000 or $1,100,000. Then it's stabilizing. It's actually re-stabilizing the neighborhood because it's bringing it current and keeping creating a leveling off feature or maybe an increased appreciation feature. Not just I'm buying a crappy house and I'm gonna leave it that way. No.
And in some cases, I mean, not everybody's gonna look at it like this, but some investors do come into neighborhoods and make them a little bit better by bringing better how to say. The houses look a lot better. People want to come into the neighborhoods, and it's going to help lift the values of the neighborhoods all around. So that, I think, prompts a little bit.
It can, but let's not give big investors. Let's not let them off the hook. Okay, you literally gave me a one-word answer when I read the title. You're like BlackRock.
Well, okay,
BlackRock, Blackstone, all these guys. Look, I'm not. I'm not friends with these guys, okay? I'm on the side of homeowners getting homes. Right. My point in bringing that up, though, is that if you already own a home in that neighborhood and there's a dumpy house on your street and that dumpy house gets bought and a buyer doesn't get it, or let's say a regular borrower doesn't get it and an investor buys it, but they bring it up, okay, maybe you got done a favor. But again, I'm not going to say that puts them in my good graces because they're buying too many homes. Here's why. Number of home investors that bought from other investors reached almost 19% in December. That's about a fifth. Think of 1 out of every 5 homes. Go to page 10. Yeah. So jump to page 10. Look at that. Number of home investors that bought from other investors reached almost 19% in December. This number has ebbed and flowed from 16 to 19% over the past few years. Investors also make around 10% of their purchases on new homes and resell around 15% of their real estate portfolios. So if they resell 15%, Brian, how much are they keeping?
5.
No, if they resell 15% of their total, how many are they keeping? 85%.
Oh, yeah.
That means they're holding on to 85%. So again, back to you people saying, we're going to get these houses out of the clenches of their hands. Probably not. So given that investors buy around 900,000 homes per year, a loose calculation would put around 300,000 homes moving from owner-occupied to investor owners in any given year. That's a lot. You think about all that inventory that I'm going to say it's being kept as keep away. that isn't coming to the market for a borrower that we could be qualifying,
They're
or
just-
that we have qualified that's competing against everyone else because there's low supply.
But they're making the deals happen under.
Right. So there's a subsection of the market which is not even making itself available. Or, well, hold on. That's not entirely true. Let me say this correctly. It could be making itself available to the market by being listed, but it's still being bought by an investor.
Yeah.
It could also just be investor to investor, an off-market sale, where I'm not even going to put it on the market. I'm just going to sell you my book of X amount of homes and whatever. So it could be pocket deals, like we call them,
Yeah.
or it could be hitting the market, but it still ends up being an investor versus a regular borrower. But not, 1 out of every 5 is a lot. I mean, even 1 out of every 6 or 7 is still quite substantial when it comes
That's
to
huge.
the percentage that they're buying and selling to and from each other. Last thing on here is there's 2 more things actually. Sorry. Next to last in. The home flipper and iBuyer activity continued downward trends. So I'm not surprised by this. Only 12% of investors who purchased a home in March of 2023 were resold by the end of December. Only 12%. Again, to my point, how many do they hold then? 88% of those are holds.
And I think that's also because, if they invested that much into it, there's probably not that much profit yet. So they have to wait until either they can refinance and take their money out, or wait for it to go up a little bit more in value.
Right. But what do they do along the way? What are they collecting every
They're
month along the way?
collecting rent. Which, at the end of the day, for them, it doesn't matter. They're skinning the cat different ways. They're going to get that cat skin and get whatever that is that they want. Yeah.
Dude, hey, I'm going to tell you a funny story real quick. So shout out to my friend Make a Move Mike Harris.
Hey.
Dude, Mike Harris posted this story last week on Instagram, and he's like walking through this house in Spring Valley. I didn't want to say it was Spring Valley. And it was just like showing, he couldn't even get to a part of the house. And I literally in the comments was like, that house needs a bulldozer taken to it. It was real bad.
How much was it selling for?
He didn't say, or it wasn't in the video. He didn't
Okay.
say how much it was. It's a deal they already have. And he was just walking it, showing the video. I'm like, this place is a dump. It's a dump. But that's what these flippers are looking for. That's a place you can literally bulldoze.
That's a gold mine for somebody.
Down to the foundation, rebuild it. It's going to be restored in the neighborhood. Because I'm telling you, Brian, this place didn't look like it had been lived in for maybe 5 or 10 years minimum. Gosh. And even in the quick glimpses I got, like the inside the wall was just, it was, the framing was like eaten away and it was rotted and it had mold. It was it was disgusting. And I wasn't even there. This is me watching it through my screen. It was
Disgusting.
gross. So I'm not going to say that there isn't room for home buying or home flippers anymore. I'm just saying that what it is showing here in this CoreLogic report is that it has been on a downward trend, and I'm not surprised by that. It is definitely hard work. Anyone who thinks it's easy to take an entire house and flip it and put it back on the market and remain profitable, you must also be really good at it, because if you're just sitting that and saying that from your couch, good luck to you.
Watching HGTV.
Good luck. Good luck.
I could do this. I could do
Yeah,
that.
a home flip happens in
Wow.
20 minutes with commercials in between, right?
I could really do this.
Yeah, 30-minute show distilled down to 21 minutes.
I had my sister the other day, as I was posting houses, she's like, do you guys take cash? And can we buy no contingencies? How fast can we close? I replied back to her, who let you watch Selling Sunset here, huh? Like,
God.
Jesus.
All right, so the final part on this, Brian, is California led the U.S. for home investor share in 2023. Again, not surprised by this. So the figure here shows home investor shares for 2023 by state. California at 35%. That was not surprising to me. But here's what's surprising. Georgia was number 2. Then New Mexico. I was like, I never thought New Mexico would be on this list at all. Kansas, and then Texas and Nevada and Arizona.
I've been hearing a lot of people wanting to go to Kansas.
What?
Yeah, I had probably like in the last 2 weeks had like multiple.
Are you for
people.
real right now?
I promise. I had.
I have. When's the last time we've mentioned the state Kansas on our show?
That's why I
ever?
circled it, because I'm like, hey, finally, yeah, Kansas, Alabama. I was like, whoa.
We hear Texas, we hear Nevada, we hear Arizona, we hear Tennessee, and we hear Utah less. I don't hear about New Mexico a lot, and we don't hear about Kansas. But that's interesting. No, so for investor share, let's go through this. California 35%, Georgia 34%, New Mexico 33%, Kansas 32%, Texas 31%, Nevada 31%, Arizona 30%, Tennessee 30%, Utah 30%. Now here's what's surprising to me about these is some of these places have very low thresholds, a low barrier for entry to be an owner.
Yeah.
So New Mexico and Kansas And I'm going to also say Tennessee.
Parts of Tennessee, yeah.
There's parts where you can totally get in. I was really surprised that these numbers are over 30% in those states.
I'm not surprised by Tennessee. I have buddies out there that literally left 2 years ago to just start buying literally houses in random, bad neighborhoods. And now they're literally crushing it because they're crushing it. And then they went and did connected with a government, and they get their rents paid by the government. So everything's on Section 8.
Like Section 8?
Yeah.
What?
So they went in there and bought like neighborhoods, Andy. Neighborhoods. And they put them all on Section 8. I was like, dude, that's smart. But they left like 2 years ago to basically start. Now they're starting to see basically their profit and their earnings and stuff like that.
So here's the connection that's it's interesting to me though is that that rate's really high in some of those places, but here's where it's really low. Only Wisconsin, Louisiana, North Dakota, New Hampshire, and South Dakota had investor shares below 20%. So these are states where investors own less than 20%. But I'm not surprised by that. You know why? For the same answer a minute ago, low barrier for entry. So what's really weird to me is that in Wisconsin, Louisiana, North Dakota, New Hampshire, South Dakota, the investor share is really low. Of course, because a lot of people can qualify in those areas, at least for the price of home and commensurate income, and you can get in. I just thought that the same was going to be true for New Mexico, Kansas, and for Tennessee.
We saw a property that was worth $20,000 in Detroit the other day, and the projected $20,000 multi-room, 2 stories.
I saw a 20-year-old truck on the street that was listed for $20,000 with 150,000 miles.
So okay. And the projected rents for that area, I believe, were like $1,800.
Wait, what?
Yeah, it was. I watched it with Will. It was ridiculous, but the house was
wait.
Yeah,
why is it 20,000?
I don't.
Is it uninhabitable?
So there's probably something wrong with it, but in that area,
probably.
But no, because houses there, the highest price house was $60,000.
Oh, jeez, what? I mean, look again. I know there's a lot of information that's missing from this. Even if you were telling me, that place is $40,000 and it rents at $1,800 a month, you could tell me it was $40,000 and $1,500 a month. That still pencils out real fast. Okay, well, we're gonna have to end the show so we can go buy that place. Anything else on this?
So we're actually about to close on it.
Anything left on this one, Brian, about the investor share? I appreciate CoreLogic bringing all this. I mean, there's a lot of graphs. I know we flashed them on the screen here for you today, but
one of them was the iBuyers crashing. I think 2 years ago when Zillow and the big techs tried to get into an overpriced homes, that really propped all the prices to stay artificially elevated. And I think that's still something that we're going through right now. And a lot of these iBuyers realized that they couldn't go back and basically play the game and then resell it for a profit. So they got caught either selling at a loss and either still losing out on their investment, but still keeping at a higher elevated price of what they sold from what it should have actually been when they bought it. So if somebody was buying it at market value, they're like, I'll buy it at market value times 100,000.
Yeah.
And then that automatically makes the prices go up 100,000 on houses that aren't even worth that much. So that's a huge piece that is talked about, that now they're, starting to see that it didn't work out how they wanted it to.
Yes. So very, very critical point. Very good point. I like that you mentioned that because I also thought, I forgot to mention that, there are now a lot of cities and municipalities and neighborhoods that are putting rules for short-term rental in place.
Yeah.
And that is going to cause a problem in places that in this high percentage of investor ownership that were for the specific reason of short-term renting, those could potentially be under duress soon. I don't know if it's going to be right now. I have started to see a couple of places where there's like pockets of a lot of vacation areas where there are a lot of listings that are going to come onto the market because the rules now state no short-term renting. I think that is maybe a couple of blips on the screen we're going to see. I don't know it's going to naturally saturate the entire nation and draw down prices. I just think we need to be aware. Just keep your eyes open is what I'm saying.
I mean, investors are driven by their margins and by their returns. So as soon as they start, not seeing those returns and those margins deplete, they're going to start offloading the ones that don't make sense or they just aren't profiting. And
well, because you're making an investment choice at that point.
Exactly.
It's this unemotional part you were talking about before. It's like, hey, this ain't penciling out.
I'll take this loss, take this money, park it elsewhere. I'd rather do that.
Math ain't mathing. I'm out of this. Yeah, I mean, look, we have a mutual friend who they own a lot of different deals. And like, this one deal is not working out. So I'm just going to take the loss because the rest of my gain nets it out like substantially. So it doesn't matter. I'm going to cut off the things that's losing me money.
I'm over here like, I just got to read you a budget for the next couple of
Yeah.